afternoon, everyone, and welcome back to the post-afternoon tea session. Just while everyone's kind of getting settled, just wanted to let you know that we will be sending out all the presentations through a web link, which after which you can download. And I guess that should happen sometime next week. So please wait for that email to come. Thank you. Okay, so the rest of the afternoon, what we'll do is we'll get to our keynote address, and then we'll just follow it up with the lucky draw for BOQ and so on. We should not forget that. Remind me if I do. And of course, it'll end with the word of thanks from, sorry, we actually have another surprise, so I'll let you know very soon. And then, of course, we'll have the word of thanks from the chairman. So, without any further delay, let me introduce you to the next topic. It's a keynote address, and the topic is Shared Future in Difficult Global Economic Environment. Just a brief precursor to the topic. The ongoing instability of the global economy has seen widespread review of board and executive positions as organizations seek to mitigate the risks of potential governance failures. The GFC, the global financial crisis, brought in renewed focus to improve internal efficiencies and brought into question the broader contribution of each senior management and board position. More than ever, these positions are required to add value to operations, and key stakeholders are demanding that this value be both visible and measurable. So for all the accountants and the finance managers and budding CFOs, the opportunities to create value have increased considerably as boards expect more from the role than ever before. The CFO must serve as a financial authority in the organization, ensuring the integrity of fiscal data and modeling transparency and accountability. Just for reading what boards expect from their chief financial officer. This is from the CFO series. It says, the quote starts, the CFO of tomorrow should be a big picture thinker rather than detail oriented, outspoken rather than reserved, prefer to delegate rather than be hands-on, emphasize what gets done rather than how things are done, and make collaborative rather than unilateral decisions. So this is from the KPMG CFO Research Services Asia. So that was kind of a brief kind of precursor to the topic of economic turmoil and a bit of instability. And that's where our next speaker, our keynote speaker, comes in. He's had virtually 4 careers as an economist and academic, as a businessman, as a political advisor and politician, and in the media as a columnist and commentator. He's worked as an economist for the Australian Treasury, the RBA, IMF, head of School of Economics at UNSW, Dean for Macquarie Graduate School of Management. In business, he's best known as the founder of Macquarie Bank, probably you guessed by now, Chairman ABN AMRO Australia, and as the Chairman and Director of a host of other public and private companies and charities. In politics, he was the Chief of Staff and Advisor to the Prime Minister and Treasurer in the Fraser government. After being elected as Member of Parliament, he became the leader of the Liberal Party and federal opposition from 1990 to 1994. Since his departure from politics, he has written extensively for the business and general press and spent time on the lecture circuit. In his writings, he demonstrated an increasing focus on corporate, social, and environmental responsibility. He regularly writes articles in the media for BRW and AFR. Recently, a significant focus of his career has been in Asia, including China, and he was recently Special Advisor on Infrastructure Finance to the Executive Director of UNESCAP. So today he will be sharing his insights on the current global economic scenario. I would request everyone to welcome our friend and advocate of our chapter and India, Dr. John Hewson.
Good afternoon. Thank you very much for having me. I'm very honoured to be here and in support of this chapter. The main reason I'm here is that your team is a pain in the behind. When he asks you to do something, you say no, he keeps at you until you agree. So I just have to acknowledge my friend Yateen and the fact that he led on me pretty hard to come. I'm also pleased though because I'm a firm believer in the potential of the relationship between Australia and India. And even though I've had a mixed experience with India myself, my first trip to India in the early 80s, I was working as an advisor at the United Nations, UNSCAP from Bangkok, talking about debt issues in India, and I got amoebic dysentery and nearly died in a Thai hospital. So that was a good start from the point of view of my relationship with India. More recently, when I was there, I had a table made, a marble table, inlaid marble table, a beautiful piece of work, but I begged them not to ship it to me in straw, because our Australian customs people, you know, they go berserk if straw comes from India. Anyway, they shipped it in straw, and it cost me more to have the straw burnt than it cost me to buy the table. But anyway, I'm very pleased to be here, and I've been asked to talk a bit about how I see the economic political scene internationally and here, and to say something about the potential, I think, for relationships between our two countries. I've been forecasting or advising on economies since the late 1960s, when I started working in the International Monetary Fund. And that was quite a time of enormous international turmoil. It was the end of the Bretton Woods system of fixed exchange rates. The oil prices were quadrupled by OPEC. We moved into a period of stagflation, which the world hadn't experienced. We had all that post-war stability in the Western world of low inflation, low unemployment, and suddenly we had stagflation with double-digit inflation, double-digit unemployment. Tumultuous times, and over the years there have been a rolling series of booms and recessions. And in my time, without wanting to blow my own trumpet, I've managed to pick most of the major turning points, whether it's a stock market crash or a recession or the global financial crisis most recently. You could see the forces building that would lead to some type of economic, significant economic experience, if not catastrophe. But when I stand today and say, where is the world likely to go from here, I think in those 40 years it's harder today to predict than it's ever been. For a whole host of reasons, but a lot of things have changed or are changing. And while we got used to being able to predict and believe in certain trends in economies and so on, there's a lot of structural change taking place. And while it's caused the world a very significant problem in the last several years, I think it provides, in terms of the theme of this conference, a lot of opportunity. When I think of why things are so different, I can point to a number of factors. Firstly, the orders of magnitude involved today in policy changes and so on are much greater than anyone's experienced. When I was a professor of economics, for example, we used to teach the limits of policy. How much it was realistic to imagine you'd be able to change interest rates or the budget deficit, for example, relative to GDP. I remember when I was a student, for example, one of my colleagues produced a macroeconomic model that had assumed negative interest rates, and his thesis was thrown out by the university as something that was quite inconceivable. Yet we've had negative interest rates at some times in some countries, and Japan most recently as an example. We used to say that if the budget deficit was moved more than a couple of % of GDP, you'd be assuming the impossible. The political tolerance and circumstances would never see budget deficits move that much. Yet in this response to this global financial crisis, our budget was moved from surplus to deficit by about 8 percentage points of GDP. In Ireland, they moved it by 17 percentage points of GDP. These are massive orders of magnitude, and we have no experience in most of macroeconomic theory and policy of forecasting economies in those sort of extreme circumstances. Associated with that has been an enormous amount of volatility. much greater volatility in financial markets than we in fact became used to. And you can still have several hundred points movements in the Dow, for example, on a day, up or down, up one day, down the next even. These again are causing all sorts of uncertainties that have never been there before. One of the reasons for that sort of volatility is that financial markets trade instantaneously. They trade it every second of every day. And of course they respond to news, they respond to economic developments, economic data and so on. But they're also second-guessing political reactions to economic events. And while the politicians aren't particularly good at predicting political events, the markets are even worse. And you're getting extreme volatility by markets simply trying to second-guess what the politicians are going to do. The problem is, as I say, markets trade instantaneously, but politicians take time to make decisions. Have to go to cabinet or some committee or some caucus or some parliament or some G20 or some IMF meeting, and these take a lot of time, and there's a lot of scope for uncertainty and volatility and second guessing through that period. A third reason I think for the uncertainty is that the economics profession is not terribly helpful these days. And we've had periods where we believed that we were Keynesians, and then we believed that we were monetarists, you know, and now I'm not sure what a lot of people actually believe is the right answer. Because, you know, monetarists used to believe, for example, that if you flooded the economy with money, you'd quickly ignite inflation. Yet in the last few years, the world economy has been flooded with money and nobody's spent it. And so you haven't had the inflationary consequences. In fact, you've had periods of deflation associated with massive increases in the supply of liquidity to markets. I mean, it was inconceivable a few years ago to imagine that the US would have had all the money injected that it's had into its economy from the fiscal side, from near surplus to a $1 trillion deficit. A whole host of money generated by the Fed in terms of buying securities, government and other securities, and then quantitative easings number 1 and 2 and maybe 3, with Bernanke, the Fed chairman, standing there saying, I'm going to keep interest rates, don't worry, I'm going to keep interest rates down at near zero till 2015. I mean, these are uncharted waters like you've never imagined. And the world doesn't quite know how to respond to that. When I look at the economics profession, then I see a whole spectrum of advice. At one end, you've got those who believe you must have austerity. You've got to bring the budget deficit under control, you've got to repay the debt, and that'll create, in some sense, the scope for the private sector to recover, without actually explaining what's going to stimulate the private sector to recover. At the other end of the spectrum, you've got people like Paul Krugman saying, look, basically the world's in a depression, it's just a question of how deep it goes. And, you know, if you keep pushing austerity into economies, you will perhaps precipitate a depression. And when you look at a country like Greece right now that's in its 9th or 10th consecutive quarter of negative growth, and the government is still under pressure to be more austere and to cut back more, you start to ask how far down is it going to go before it can possibly turn around and start to grow. Austerity means basically it will get worse in economic terms before it gets better. And these are very different worlds, a very different world to what we were used to even just 5 or 10 years ago, let alone what's been the whole post-war period, the experience of the whole post-war period. But there is a limit to what governments can do in terms of austerity as well, and you're seeing that in terms of the social pressure that's emerging, the social consequences, the marches in the street, the quite violent reactions in Athens, for example, when each austerity package is being announced, or in Spain. And these countries are in real difficulty. In Spain today has got an unemployment rate of about 25%, and a youth unemployment rate of about 50%, and you're saying, okay, you've got to cut back. You know? And there's no concept of how much more you'll need to cut back, but clearly there's a limit to how much the community, the society will accept in being cut back. And so governments are finding that they still have large debts, large budget deficits, and an incapacity to actually bring them under control because they can't inflict any more pain on their citizens. A couple of years ago I was in Ireland with the Trilateral Commission. We met the Prime Minister of Ireland, and he was documenting the detail of their austerity measures, which were really quite severe. This was in May of the year. They'd cut wages across the board by about 20 or 25%. They'd cut government expenditure by a similar order of magnitude. They'd nationalise their banking system and so on. A whole host of measures. That was in May of the year, and the Prime Minister was absolutely confident that would turn those circumstances around. In November they were in default. It doesn't take very long to slip, and you're seeing that process run in Greece, you're seeing it run in Italy, you're seeing it run in Portugal, you're seeing it run in Spain, and so I can go on. And there is no firm view about how that process is going to unwind. So just looking at Europe, I think Europe's in a very difficult set of circumstances, and the social dimension is at least as important as the political dimension. I mean, Europe has a common currency. I want you to think about what I mean by common currency. Australia has a common currency. Right? We have one currency for all the states. And yet some of our states are performing exceptionally well, very strong, and some of them are very weak. Tasmania is at one extreme, for example, with sort of negative activity, and we have the mineral boom in Western Australia. So how is it the Australian dollar is not under the sort of pressure that the euro is under? And the reasons are pretty obvious. We have pretty free flow of people between states, so you can move around Australia to get a job. It's not as mobile as you'd like it to be, but it's mobile by the standards of many other parts of the world. But most importantly, we have a level of political unity and policy unification. Essentially, we've got one interest rate, one government interest rate, one government monetary policy, and the fiscal policies are all pretty much coordinated within the same sort of broad framework of the Federation. And it's made to work because we transfer money from the richer states, the more successful states, to the poorer states. And while you hear Western Australia complain about their GST revenue going to Tasmania, or New South Wales not getting enough, or whatever, fact is it works. Now in Europe, it's exactly the same thing, except perhaps the differences between some of those states, those 17 countries in the euro, are more extreme. You've got countries like Germany that are extremely strong and have benefited enormously from having a euro, because if they'd stayed as a mark, the exchange rate would have been up here, and now they've been able to keep it low and exploit that with an export-orientated strategy, pretty much like the Chinese are doing by holding down the value of the yuan. At the other extreme, you've got countries like Greece that are not performing, and you have very significant cultural differences. The Greeks don't like to work hard. The Greeks don't like to pay tax. They like to retire early. And so what you're really doing within Europe, if I can oversimplify, is asking some German in a manufacturing plant, in some dingy manufacturing plant, probably in the back blocks of Germany, to work harder and longer so that some Greek public servant can retire early on a very generous pension. And that is very real social pressure in the world where they don't have political unity and unification like we have, and they don't have the coordination of fiscal policy in particular, and even monetary policy to a lesser extent, that is required to make it work. So the pressures are always going to be there, and they show up in financial markets. They show up in financial markets actually in the box seat here. They can drive a run on any currency. And up until very recently, for example, financial markets didn't like Spanish debt, then they'd make a move against it in the market. And of course the Spaniards can't respond because the debt's not in their own currency, it's in the euro. So they rely on the European Central Bank to stand in the market and buy those bonds to support the bond market. Now up until recently the European Central Bank wasn't prepared to do that. So they had enormous pressure on their, on any day there could be a run, the yields would move and the markets would get, self-fulfilling prophecy. They get more and more uncertain. If you compare that, say, to the UK's borrowed a lot of its money in pounds. There's a run on the pound, on their bonds. The Bank of England just steps in and buys the bonds and supports the market. Spanish Central Bank can't do that. Central authorities can't do that. They have to rely on the European Central Bank. Second big difference between the UK and Spain is that Spain can't devalue, and the UK can. So in this global financial crisis, the UK is devalued by 25 or 30%. The pound has gone down 25 or 30%. The Spaniards have been locked in to the euro. So their capacity to respond is very different. Yet the debt problems of the UK are bigger than the debt problems of Spain. The budget deficit relative to GDP and the size of debt relative to GDP are slightly worse for the UK than they are for Spain. That makes the point about how difficult it is now in Europe. And how is that all going to unfold? Well, you know, they're hoping it doesn't become a crisis, and that's really a strong hope. They hope that they can turn some of these countries around. Their big problem is not so much the individual countries. We know that the Greeks can't service that debt. We know they don't have the capacity at this stage to repay it. If they're given time, they might be able to adjust to bring the budget deficit down, bring the debt under control, and ultimately trade their way out of it. The difficulty they've got in Europe is that the debt is held across countries. That banks in Germany hold, you know, Spanish debt and Greek debt and Portuguese debt and so on. And the exposures of those banks are very large. Some of the smaller, some of the middle ranking, for example, German banks will have more than 50 or 60% of their capital exposed in just one or two of those marginal countries of Europe. So that the pressures are constant on the euro, and they're drifting from one political meeting to the next, one austerity program to the next, and you know, you tell me how that's going to unfold. My guess is that they'll muddle along, that they will do whatever it takes to keep the euro in place rather than let Greece go out of the euro. You think of what it would involve for Greece to go out. You have to start with a new currency, a new accounting system, new standards, new everything, you know. Imagine how difficult that would be. New contracts, rewrite the whole lot. It's unlikely to happen. They're trying, I think, to keep it together at all costs, but the cost is very real. The stabilisation fund they've got in place isn't anywhere big enough to cover the exposures of the banking system. They're judging it from day to day. They get by here, a bit there. Hopefully they'll be able to muddle through. Bottom line is very low growth for a very long period of time in Europe as a whole. And you say that can't happen. Well, it can happen. If you go back to Japan at the end of the 1980s, there wasn't one person in the world who predicted that Japan, which had been the success story of the whole post-war period, right? It had been the development example, the great success, Japan Inc. Countries were copying it, Koreans were copying it, you know, the Thais were copying it, and all of a sudden fell in a hole at the end of the 80s. And what we've had since is a series of rolling recessions and deflation, with zero or negative interest rates, with a fiscal stimulatory package almost every year, with the Prime Minister almost every year, and we still haven't made any difference to the fact that Japan is still bumping along the bottom. So you say it can't happen, that's a lot longer than anyone imagined was possible. The structural dimensions of their issues are very real. They had a really big problem with non-performing loans and interlinking shareholdings between companies and government and so on. Japan Inc. Had to be unbundled. It's been a very painful process and it's still not done. So I'm very pessimistic about Europe. And when I look at the leadership in Europe, you don't have strong leadership. You know, and some of those who've tried to make significant change, like Cameron, have probably run their limit. The UK could even triple dip this year. You get a bit of a benefit from the Olympics, but then it could go back down in the third and fourth quarter of this year. I suspect that's what will happen. So I'm pessimistic about Europe. And I turn to the United States. We've just had an election, and I didn't learn anything out of that campaign. I didn't, Romney and Obama went out of their way to tell me very little about what they do with the US economy for the next 4 years. And can you believe it? They had 3 debates. They didn't mention the fiscal cliff. The fact that at the end of December, the budget deficit in the US, which is presently somewhere over $1 trillion, we don't know the number because it hasn't yet been declared, it's in excess of $1 trillion, will automatically be reduced under existing legislation to $530 million. That's a king hit on the US economy, 3 to 4 percentage points of GDP, instantaneous recession, if it were allowed to happen. It's in legislation. That legislation reverses the Bush tax cuts, it eliminates a whole lot of other tax concessions, payroll tax concessions and other things, and makes cuts across about 1,000 projects, programs in the government, including health, including defence. Now, of course, it won't happen, but can you believe that the whole election campaign forgot to mention that elephant in the room? The biggest economic challenge that country's faced in decades, and it's sitting there and they didn't talk about it during the election campaign. And of course, the way the US political system works, they don't do media. Right? We get used to our politicians doing a doorstop or a press conference almost every day. In the last 2 weeks of the campaign, neither Romney or Obama did any interviews of any type, soft or hard or anything. They didn't do any. They just rely on the television image every night of that campaign rally they do, and they only campaign in 10 of the 50 states because they're the battleground states. The rest of them are already locked up. So they'll go to Ohio 15 times and not go to a whole host of states ever in the course of the campaign. It's a bizarre world. Then only half the people will vote anyway. And we call that democracy, the world's leading democracy. It works very well. It doesn't help you work out what's going to happen in terms of the US economy. It doesn't help you at all. And in terms of the debates, as I say, they didn't mention that. To me, the US has got three major problems. They're war weary. I didn't hear anybody talk about that in the campaign. They have the fiscal cliff as an economic challenge. I didn't hear anyone talk about that in the campaign. And their standing in the world is in decline. And they all said the reverse in the course of the campaign. So, the reality of that debate was quite divorced from the reality of the circumstances in which the debate was taking, the debates were taking place, or the campaign was taking place. So the difficulty we've got now is what will happen. Will Obama be able to do a deal with Congress? And the polling that's taken place since the election, an overwhelming majority of Republicans believe that Boehner and the team in the House, on which the Republicans have control, have a mandate to be very difficult when it comes to dealing with Obama. Not make his life easy at all, give him a hard time. Yet it's going to be brinkmanship of the worst order. What's going to get cut, what taxes are going to get increased to get some improvement in the deficit, to get rid of that fiscal cliff at the end of this year. And, they're very good on brinkmanship. I was there last year when they had that big debate about closing down the government, to the last minute. They went to the 13th hour. They haggled about only $38 billion worth of expenditure in a budget deficit of $1 trillion. They haggled about that right to the end. And the end would have been no more pensions, no more government benefits, no more, it would have basically